Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, March 1st, 2021, and I'm pre-recording this Trading Places Live for Tuesday, March 2nd. Futures currently are mixed, slight gains on the NASDAQ, slightly lower on the Dow, and just about flat on the S&P 500. Of course, that can change overnight. We did have a big day on Monday, which I'll go over in just a couple of minutes. But at least for now, it looks like futures are holding the gains that we saw on Monday. Before we get going, let me at least run you through the agenda for today. I'm going to start off with the daily market recap. Then we'll get into talking technically, seasonality, momentum sleepers, earnings spotlight, and we'll wrap up with the three you must see. First, let me take you over to our website at earningsbeats.com. If you are new to Earnings Beats, you can see over here on the left-hand side, we do have a free Earnings Beats Digest newsletter. This is a newsletter that gets published 3 times a week, Mondays, Wednesdays, and Fridays in the morning. Normally before the market opens, you'll get it. Simply type in your name, email address, hit the subscribe button. You can join our community. Normally, we're talking about earnings, relative strength, some of the things that are really important to us at Earnings Beats. It'll give you an idea of how we approach the market, and I think it'll help in your trading. But simply type in your name, email address, hit that subscribe button. It's completely free, no credit card required. You can unsubscribe at any time. If you'd like to try our paid service, you can click on that green Join Today button, and you'll pay $7, but we'll refund that $7 to you within a week. So you'll essentially get a no-cost 30-day trial. You can check out our portfolio performance, which has been spectacular since we started it a couple of years ago. The model portfolio, as you can see, has been in existence. We're in our 10th quarter, and we're up 250%, while the S&P 500 over the same period is up 45%. But you can see all of our portfolios are now ahead of the S&P 500, even our more conservative income portfolio, which focuses more on dividend growth. We have had a super start to this quarter in the income portfolio. You can see this quarter up 5.63%. It just started February 19th. So it's only been in existence here for roughly 10 days or so. So the income portfolio has done extremely well. The S&P 500, the benchmark, you can see this quarter since February 19th down slightly. 2 of our 4 portfolios, though, are beating the S&P, even though we focus a lot on growth stocks, which have been out of favor for the most part since February 19th. But anyhow, I think they've done really well. You can see our ETF portfolio performance down here also beating the S&P 500. So if you'd like to check that out, plus all the other research tools that we offer our members, all the education and so forth, you can sign up and, again, try us for 30 days. Love to have you. As far as the market went on Monday, beautiful action, great day. I know last week had a lot of folks concerned. I thought a lot of it had to do with options expiration. And sure enough, we start out a new month and right back up we go. Dow Jones Industrial Average up almost 2%, 600 points. S&P 500 up almost 2.4%, up 90 points. Back above 3,900, so not too far from an all-time high again. The NASDAQ, which had gotten beaten up really badly here since the middle part of February, rebounded 396 points, more than 3%, to climb back to 13,588. That actually did clear the 20-day moving average, 13,584. So after trading below it for over a week, we were able to climb back above it. At least in the short term, that was a positive. We'll see if we hold it on Tuesday. Mid caps had a pretty good day, up 2.7%. Small caps, best out of all of them, up just over 3%, 3.05%. Both mid caps and small caps on the verge of breaking out to fresh all-time highs. As far as sectors go, technology, financials, energy, communication services, and industrials leading the action. Of these 5, 4 of them are aggressive groups: technology, financials, communication services, and industrials. The only one missing, consumer discretionary. Energy was the odd one out, or the odd one in, I should say. This was up 2.6%. That was despite crude oil prices down throughout the day. So energy held up pretty well. I'm a little concerned about energy, and I'll talk about that in just a few minutes. But overall, really good day. You can see all of these gained at least 2.5%. technology up over 3%, financials over 3%. Every sector was higher on Monday. So it was a very, very wide participation advance, and that's what we like to see in a secular bull market. The 10-year Treasury yield, as far as economic reports go on Tuesday, really not expecting anything of any significance on Tuesday. So the 10-year Treasury yield will have to just trade on what, all the information that's currently out there. It did pull back a little bit. We saw about a 1.5 basis point drop in the 10-year Treasury yield, finished 1.45%, a little bit below 1.45% after moving above 160 last Thursday. So we've pulled back a little bit, and I'm expecting to see a little bit more pullback, a little more consolidation here as we head toward the jobs report on Friday. Then we'll see what happens once the jobs report comes out and how the bond market reacts to that. If we can stay under that 160 level, preferably even 150 through the jobs report, and we have a decent jobs report, I think that would really set up well for the market. But we'll see how things go through the balance of the week. All right, I'm going to move into talking technically, and I'm going to focus here on the U.S. dollar and how I track the U.S. dollar. I think, and I give John Murphy a lot of credit because I studied a lot of his intermarket relationships when I was doing a lot of my own analysis, the technical analysis, pretty much self-taught, but I did listen a lot to John's books. I would highly recommend his John Murphy's books, and you can find those in the bookstore at StockCharts.com. But one of the things that I look at, and it's not only the things that I learned from John, but the things that he inspired me to research and to look at. And so I'm always trying to figure out, well, if something does this, what does that mean to something else? And one of the things I noticed as I did more and more research, I'm always comparing things going on in the US to things going on in Germany. And the reason I do that is that I found that the correlation between the two countries is pretty strong. Stock market correlation, if you look at the DAX versus the S&P 500, when one's doing something, the other is generally doing the same thing. And that is different than if you look at, say, something like the Shanghai in China and compare that to the S&P 500. That's like a random, it might follow and it might be exact opposite. There's just no real correlation one way or the other. It's so random. And that's why when I listen to any of the news and they start talking about, well, the US market's doing this because of what's happening in China, I think, well, there's really no history of that. The two countries tend to operate independent one another. Their markets do. But in Germany, we do tend to go hand in hand with Germany. So anyhow, in this chart, what I was doing was comparing the difference between the US 10-year Treasury yield and the German 10-year Treasury yield. So it's just the difference, the mathematical difference. So just the German 10-year Treasury yield subtracted from the US 10-year Treasury yield. So it's not a ratio. It's simply the difference between the two. And I plot that on the chart. You can do that by putting in $ UST 10Y minus $DET 10Y. And if you do that, you'll come up with this and you can follow it. But if you go back to 2008, I mean, you can kind of see that we've been, for the most part, US Treasury yields have been moving up relative to over in Germany. So part of the time, the US Treasury yield may have been going down, but it wasn't going down as fast as the German 10-year Treasury yield. So it's just the difference between the two, and the difference continues for the most part to go higher. Well, if you look at that chart and then you look at the US dollar index, you'll see that essentially we kind of slope in the same direction, kind of move together. And then when I check the correlation between the difference in the two countries' yields and the direction of the US dollar, you can see that we're mostly in positive territory. We spend a lot of time up near one, and certainly a majority of our time, or a lot of time, up above, say, the 0.5, so positive 0.5. So it's not they're not in lockstep with one another, but there's pretty strong correlation. So we only go negative, period, not very often. And to go beyond, say, minus 0.5, you can see I've circled the times that's happened. Hasn't happened too often, not like it has to the positive side, where we do it quite a bit and get up close to 1 even. You down here, even getting to minus 0.75 has been very rare. But that inverse correlation is what interests me. So what I've done is I've highlighted the times where we've seen the dollar go in a direction different than the difference in the yields. So here you can see in these green shaded areas, the US 10-year Treasury yield is rising relative to Germany, which is saying we should see the dollar going up. But the dollar was going down in these instances where we have green shading. So the difference in yields going up, the dollar down in those 4 instances. In each of those 4 instances, we see the negative correlation, inverse correlation. And in all of these cases, when we got this turn back to the upside, you can see when this turns, it tends to turn and go all the way back up into positive territory. And when that happens, in each of these cases, the dollar plays catch up. So notice they're going opposite. It's not the yields coming back down to catch up with the dollar. Instead, it's the dollar going up to catch up with the difference in yields. We saw it here in 2009, 2010. We saw it again 2014 to 2015, playing catch up. And then we saw it again in 2018, playing catch up to what was going on with the difference in the yields. Now, what we've seen recently is the yields in the US going up rapidly again versus Germany, and the yields were going, or the dollar index was going down. But notice we're starting to hook back up again, and look at the dollar starting to turn higher. That's really important because I think the dollar is going to accelerate back to the upside to play catch up to what we're seeing with the difference in the yields between the US and Germany. And if I'm right, I want you to focus on, this is a 20-year chart. The US dollar is in the top, and then energy relative to the S&P 500, and then materials relative to the S&P 500 are in the next 2 panels. So here you can see when the dollar was going down from 2002 to 2008, most of that was during a cyclical bull market from 2002 to 2007. During that bull market, because the dollar was weak, energy and materials led the S&P 500. They actually outperformed the S&P 500. Then the dollar went choppy for 2 or 3 years, and relative strength went choppy for 2 or 3 years on energy and materials. And then once we bottomed in 2011, and again, this coincides, this bottom in the dollar coincides with this yield moving up. Now we've got the yield moving up again. So I think the dollar is going to turn back up. Now, what does that mean? Well, if the dollar turns back up from here and starts to roll back to the upside, look at what's been happening throughout the last 10 years when the yield or when the dollar's been rising. Now we've seen energy underperform. We've seen materials underperform. While the dollar was weakening for the last year, we saw, well, energy came back here the last maybe 4 months on a relative basis. Materials the whole time, though, for the most part, has been outperforming. But what happens if that dollar goes back up? I think both these relative strength lines turn lower, meaning that energy does not keep pace with the S&P 500, neither does materials. And so when I look at the market and I see secular bull market and I think rising dollar, I want to stay away from energy and materials. I want to stay away from the defensive areas. So that leaves me with the 5 aggressive sectors: technology, consumer discretionary, communication services, financials, industrials. Those are the 5 that I think we need to continue to focus on. All right. One last thing in talking technically before we move on. This is unrelated, but I do follow growth versus value. And I was mentioning this at Earnings Beats on Monday morning in my Trading Places live show there. And you can see for the first time, we started to show a little bit of strength in growth versus value. First time in the last 2 or 3 weeks. And we actually added to that strength on Monday. So growth stocks broke out on a relative basis above the high we saw on Friday. So it doesn't look like at least we're trying to move back up here in this ratio. And if we do, that will help the NASDAQ. It'll help some of these growth oriented stocks. And those are the stocks that have been leading for a while. After hours, Zoom came out with a huge report. I'm going to talk about that in just a few minutes. But that's a stock that could certainly benefit from growth stocks leading. But we'll watch that. 1.69 on this ratio is really important. I'm not going to pull it up, but if you go back about 9 months and look at this ratio, you'll see that 169 was a top. We broke above it several months ago. And every time we pulled back to 169, we held until just recently. Last week, when we started seeing all this selling, we lost that 169 level. Now we're coming back up from underneath. So if we can get back through 169, that would be, I think, would be very bullish, not only for the overall market, but for growth stocks more particularly. All right, let's move on to seasonality. And this is something I mentioned over at Earnings Beats for our Trading Places Live on Monday morning as well. And I think this is something that is really important that everyone should understand. If you look back at history, the stock market, every day is not equal. Every week is not equal. Every month is not equal. There are historical tendencies that you need to be aware of. And if we look over the last 20 years and we look at the S&P 500, if you add up the average returns for January, April, July, and October, those are the first months of each calendar quarter. January, April, July, and October. If you add those up, you'll come up with 4.3% for those 4 months. And that's just average returns for those 4 months. So if all months were created equal and they all were about what those 4 months did, then we'd have to multiply that 4.3% times 3 to get to 12 months, which would take us up to about 12, 13%. Now, if you take the second month out of each quarter, February, May, August, and November, and you add these average returns, you'll come up with 2.5%, less than the 4.3% that we saw in the first month. Now, I can tell you the first month, I think there's always going to be a run-up into earnings season. Well, I said not always, but historically, that's the tendency. You have prices rise heading into earnings season. February and May, the second month of each quarter, you've still got earnings coming out. You've still got reactions to earnings, and you do pretty well. 2.5%. Multiply that times 3, and you're at 7.5%. Then we take the third month out of each calendar quarter, March, June, September, and December, and you add those together, and you get 0.6%. Multiply that times 3, and you're only at 2%. Things tend to tail off in this third quarter of each calendar quarter. And money also tends to begin to rotate more toward defensive groups. I'm not saying that's what's going to happen here in March of 2021. I'm giving you historical tendencies. So, as I said on Monday morning at Earnings Beats and Trading Places Live, the moral of this story is lower your expectations for the month of March. This isn't January. It's not April. I mean, you can see the S&P 500 really likes the month of April, and we're going to get to that. But first, we got to get through the month of March. Now, when you break down the month of March, I'll give you some numbers. This is going back to 1950 on the S&P 500. March 1st to March 5th has an annualized return of 40.96%. Very bullish. The most bullish time of the month are the first 5 days of the month. Today was March 1st, which happens to be the best day of the month, by the way. So we got off to a good start like we typically do. But if we have a good, strong week this week, you might want to just kind of temper your enthusiasm after that. March 6th through 9th, minus 21.42%. March 10th through 18th, plus 31.28%. And then March 19th through the 31st, minus 1.68%. So once we get through the 1st or the 5th, that's when we've, made most of what we're going to make for March historically. Again, that doesn't mean that's what's happening this month, but I just wanted to point out that those are the seasonal tendencies. So just keep in mind March, June, September, and December. If you add these averages up, you're not much above zero. Again, it was 0.6%. Now, maybe March, because we did add 1 day today, so that would be averaged into this. Maybe it's a little bit higher. That would be 0.4 even. Yeah, I'm at 0.7. Or this morning when I did it was 0.6. But because of the strong day we had today, that must have gone up by 0.1%. Anyhow, the point is, be careful the third calendar month of each calendar quarter. All right, let's keep moving on. I'm going to move to momentum sleepers. Now, momentum sleepers, the way one scan that I would run, and I did this for our members, something similar to this I did for our members in the daily market report today. But for those of you maybe that aren't familiar with Earnings Beats, we do a lot of research for our members. I consider our service to be a research and educational platform. And in that research platform, we go back and we look at earnings reports, thousands of earnings each quarter. And we include companies that beat Wall Street estimates on top line and bottom line, revenues and earnings per share, that also are liquid, and also there's something about them that we like technically. Either the chart looks good, maybe on a relative basis, they look good relative to their peers, maybe relative to the S&P, or maybe it's their peers that look good. Maybe this individual stock doesn't look that great, but it's in a really strong group, like semiconductors. And so it may not be great, but may not look great technically, but it did beat Wall Street estimates and it's in a strong group. So I might include it. Anyhow, these strong earnings, these two strong earnings chart lists, we just created a second one for the first time in our history today because we went over 500 companies, and each of the chart lists can only hold up to 500 stocks. So right now, I think we're at 526 companies. And that should tell you something too about the state of the market. The fact that we're at an all-time high in companies that have beaten Wall Street estimates and look good technically and are liquid, that should say something. If we're at our all-time high, that's telling us that there's a lot of really good earnings reports out there. Anyhow, these two chart lists, also a strong future earnings chart list. This is a chart list that, let's say, you're one of the top relative strength companies out there, but for whatever reason, you didn't beat your earnings estimate. Maybe you matched earnings estimates, or maybe you fell a little short of your revenue estimate. Well, they wouldn't be in either one of these first two chart lists because that only includes companies that beat Wall Street estimates as to both revenues and earnings per share. So if you missed either one of those, but you're still strong technically, and the key there is the scooter. I use the scooter at StockCharts. If it's got a high scooter and it's not on either one of these two earnings chart lists, then we put it into a strong future earnings chart list so that we can continue to watch companies that are performing well but didn't beat earnings expectations. And then finally, any companies that are raising guidance and are liquid, and occasionally if a company's in just a horrible downtrend and they raise guidance and Wall Street doesn't care, I don't care either, and I'll ignore them. But for the most part, if you're liquid and you raise guidance, you're going to be on this chart list. So what I've done here is I've run all of these chart lists, and I'm looking for any stock in any of these four chart lists. Notice the or clause here. And then I look for scooters above 90 and RSIs less than 50. So scooters above 90 tell us that these are the best of the best. Of all the stocks in here, we're only going to consider the ones that have scooters above 90. And then going beyond that, we're only going to include companies that have RSIs below 50, meaning they've pulled back. So if you've got an RSI at 80 and you're way overbought, you're not going to come up on this. These are momentum sleepers, solid stocks, but they've been pulling back. And when I ran this, there were 26 companies. I'm not going to go through it and show you the charts, but what I will show you is the companies that you can come back and take a look at here. But these are all companies that have scooters above 90 and meet the other criteria that I showed you. All right, earnings. So let's move on to earnings. I do want to show you Zoom because after hours, Zoom was up, I don't know, another 8-9%. And they blew away the numbers. I mean, revenues were not close. I think it was like 870 million. The market was expecting maybe 810 million. And then earnings per share, $1.22 versus 78. And then they raised guidance, and the guidance was really, really strong as well. So put all that together, you can see Zoom making this push. I've been a big fan of Zoom, even though you can see it's weakened. It's been weak the last few months. You got to keep it in perspective. And we had been going higher and we'd been going a lot higher, 100 to 600 in about 7 months. So sometimes you have to go through these basing periods. I did not give up on Zoom. Zoom is one of my personal biggest holdings. And I believe it's going to go eventually back up here to test this, 570 area and break out. I think it's going to new highs. I think it's just been trying to catch up. Its market valuation got way ahead of itself. Now the fundamentals are following suit. We'll see how it does tomorrow. But if it can close back up above 450 on Tuesday, I think that would be a really, really bullish start to what could be a cup. And that's what I think we're probably going to see. NEO also reported they matched expectations, 14 cents versus 14 cents. AD line looks pretty good. This is another one that went up just so much. I would expect it maybe to continue consolidating. It was down a couple bucks after hours, so I'd be a little careful. NVAX, they missed on their numbers. They were expected to lose $1.53. They lost $2.70. Stock last time I looked was down $10 after hours. So I think we could maybe make our way back down to about the 190 to 200 area, just based on the huge move prior to earnings. Target will be reporting Tuesday morning, AutoZone, Kohl's, ANF, and a small company, Kopin, K-O-P-N. And the reason I'm going to bring this up, it's had such a huge run from $2 to $14 in 2 months. Be interesting to see how this earnings report comes out. So I just wanted to mention this. All right, let's move on to the three you must see. I'm going to go through here pretty quickly. First one, Builder, Builder's First Source, BLDR. Another one that went sideways for the last couple months, just broke out, volume pretty strong here the past couple of days. Looks like this one may start to get some legs under it. Looks pretty good to me. Alta recently broke out, but the thing I wanted to show you on Alta is actually the seasonality chart. So if we take a look, so the actual chart here looks pretty good, price chart, but look at March. 86% of the Marches over the last 15 years have gone higher. March average is 5.9%, April 7.1%. So over the last 15 years, these 2 months alone, March and April, we've averaged seeing Alta move up 13%. One to keep your eye on for sure. And then the last chart I wanted to show you was TradeWeb. Also, after you can see this long cup handle, making the breakout, volume picking up. This is a stock I see potentially going up to about 90, 95. So it's still got quite a bit of room based on this measurement. I think it looks good. Listen, everybody have a great day. Appreciate you tuning in. I'll be back over at Earnings Beats on Wednesday morning for your next Trading Places Live. That will start at 9 a.m. Eastern Standard, just as this one does. Everybody have a great day. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.